and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, with the Reserve Bank of India just announcing its last and sixth monetary policy announcement for the current fiscal, that's going to be the subject of our discussion today. And I have with me two stalwarts, Mr. R. Gandhi, former Deputy Governor of the Reserve Bank of India, and Saugata Bhattacharya, Chief Economist at Axis Bank. Welcome to the show, Mr. Gandhi. Saugata. Mr. Gandhi, let me start with a slightly provocative question. Has the RBI under Governor Shaktikanta Das bypassed the Monetary Policy Committee, the MPC? Because though the repo rate has been kept unchanged, the RBI is in effect ensuring a lower interest rate regime.
I don't think Reserve Bank or the Governor has bypassed MPC. If you look at the actual statutory responsibility that has been assigned to the MPC is inflation targeting and keeping the inflation within the statutorily bound limits of between 2 to 6 and with a central position at 4%. That is what is the remit of the MPC. Whereas Reserve Bank of India has got much larger remit, including the beyond the inflation targeting, liquidity management, day-to-day liquidity management, or even longer-term liquidity management, and also to take care of the supporting the growth. So now that the MPC has been constrained at this point in time, having seen the latest inflation count at above 6%. So obviously the interest rate action is not possible for the MPC to adopt at this point in time, and that is where MPC has said that they will continue to have the pause as of now. Beyond that, MPC cannot take anything more because given the situation of the day, growth has to be supported, and that is where Reserve Bank has found other methods of other tools to be deployed for supporting the growth perspective. This is a segment targeted, segment based approach. Identified segments, there is incentives have been given by the Reserve Bank of India for the greater credit flow or credit offtake into those segments. That's why it is not at all in conflict with MPC's remit.
Okay, Saugata, I would agree with Mr. Gandhi that the Reserve Bank of India has a much larger remit. But where I would disagree with him is when the Reserve Bank of India operates through the interest rate, which is the remit of the MPC in order to get inflation within that band. So my question to you really is that what is the idea of having an MPC to set interest rates and thereby inflation if the Reserve Bank of India is to in some way bypass and achieve the same result of lowering interest rates when the MPC has not agreed to lower the repo rate? Saugata.
I think I agree more with Mr. Gandhi, sir, than your hypothesis. The reason being that the task of the MPC, as in the role of all monetary policy committees, the FOMC or Bank of England or whatever, is to set the policy rate, the repo rate, and then the task of the central bank is to target the operating rate, which is the weighted average call rate in our new liquidity management framework, close to the policy rate, the target policy rate. After that, depending on economic conditions, whatever, macro conditions, fiscal conditions, global conditions, trade conditions, etc., the term structure of the interest rates is free to move depending to react to the conditions. Now the question is, how much should the policy authorities, whether it be the Government of India, state governments, the Reserve Bank of India, try to move the yield curve in a manner which actually is consistent with some of the other objectives. So that is the issue for debate. How much is taking on too much risk, as in all corporations do and at a national level. So what is the appropriate level of risk that a central bank or a government needs to take? Which are the areas that it needs to take that risk? In the current environment, the only way to get growth moving forward is to try to deliver credit. Now there are associated risks. I'm absolutely 100% agree with you that there are risks in the credit system, but you need to judge what those risks are, what are the key mitigants, how much risk to take on, and I think the Reserve Bank, given the current conditions, I think has done a very, very balanced job on taking these risks.
Okay, so I'm clearly in a minority here, but Mr. Gandhi, in the press conference, the governor tried to insert a slightly less dovish tone by saying that status quo cannot be taken for granted, etc. Was it an attempt to temper the view that the RBI might have become a bit too accommodative, a view that I at least subscribe to? Do you? After all, like all central banks, the Reserve Bank of India has always been regarded as a lender of last resort. Whereas now with the term repos of 1 lakh crore, it has effectively become the lender of first resort. So is there something wrong with that, Mr. Gandhi?
No, because there are lender of last resort function is from a particular perspective. When the market is not available and the particular institution is failing, and that's the time the central bank's role as a lender of last resort comes in. But when you look at from the liquidity perspective, when the central bank has to offer liquidity or absorb the liquidity on a day-to-day basis or on a much longer term perspective, if it foresees that the liquidity accumulation or liquidity requirement is going to be on a sustainable basis for a longer term, then it is supposed to be offering different types of repo and reverse repo. Just as earlier we had overnight and then 14 days, sometime even 28 days, sometime we have done even for longer period. Now Reserve Bank has come out with a much larger, longer term repo window. So it is based on the liquidity consideration. When it finds that for sufficiently longer period of time there is going to be liquidity demand or liquidity deficit, then accordingly Reserve Bank should be offering an instrument like that. Because we are not seen that kind of instrument so far, this is the first time it is being offered, so it gets, obviously it creates a kind of debate, but I don't think that we should read beyond that the Reserve Bank has chosen an instrument which is appropriate for the time of the day.
Shwagoto, are we in danger of repeating the mistakes of the post-global financial crisis, excessive stimulus? Because we're now in a situation where the RBI has to absorb a daily excess of a little over 3 lakh crore on a daily basis approximately, and yet the RBI seems to want to flood the system with further liquidity. Is it playing with fire given that monetary policy acts with long and uncertain lags? So we really do not know when this is going to play out. Shwagoto.
So yes, I mean there is a risk, one, with the extent of liquidity in the system. Even today it was over 3.5 lakh crores. So if you believe the thesis that inflation at the end of the day is a monetary phenomenon, then there is a risk associated with whatever the conditions of demand, that if at some point in time demand were to emerge from the system. But remember, whatever the level of liquidity, money supply M3 is still growing at a very modest pace, and that reflects the growth of credit in the system. So I believe what the Reserve Bank, weighing the balances, of course, I mean they are privy to the internal discussions. So what I think they are doing is, first, as you mentioned, I mean lender of last resort. It's not so much a lender of last resort, but somewhere in the middle. Second, more importantly, I think the clear signal that taking away one-day fixed-term repos and putting in a 14-1 medium-term repo once in a fortnight and then going into the 1 year and 3 year is essentially nudging banks to manage their liquidity better. So, I mean, particularly a set of banks who do not have the liquidity management systems in place, these banks are being incentivized to manage their liquidity better. Third, I think this framework is beginning to target some degree of reduction. I mean, you know, some transmission in rates, particularly at the 2-year, 3-year GSEC levels, which are the core areas for funding. So there is an attempt using the 3-year repo, the long-term repo, to try to see which it has achieved. I mean, if you see the 3-year GSEC rates, that has come down significantly. So there is an element of transmission that is also built into this long-term liquidity framework.
Okay, yes, in fact, there is the challenge of the revised liquidity framework. Mr. Gandhi, in fact, I wanted to bring you in on that. Does it really increase the kind of uncertainty in the system? Because the fact is that even for the Reserve Bank of India, it's very difficult to estimate exactly what is a desirable or the optimum level of liquidity. And let's also not forget that what is durable liquidity, what is short-term liquidity, etc. These are very difficult in practice to actually work out. So even for the Reserve Bank of India, in fact, for the most sophisticated central banks, it's very difficult. So will the revised liquidity framework complicate matters at a time when we already have enough problems in our hands, Mr. Gandhi?
Yeah, typically many central banks follow the principle of providing liquidity on a not overnight basis. It is either 14 days or even longer period, because that is where it will be possible for any bank to typically look forward and for a sufficiently longer period in time. So, there had been discussions earlier, instead of concentrating on the overnight segment, why not Reserve Bank concentrate on 14-day money or longer period. So, that way the movement away from because our market is not yet completely ready for the longer period liquidity management, because banks have to have a different way of modeling their liquidity. They were very comfortable in or rather the preference earlier had always been that overnight it should be a day-to-day management like that. So, we are not yet been able to move towards that. So, now because of these kind of windows being made available by the Reserve Bank of India, it will definitely encourage the banks to move for a longer period liquidity management, whether 14 days or 3 months or longer period. So, that down the line it should be looks like Reserve Bank is nudging them to go over that, and day-to-day management you do it at very minimal. So, that's a kind of thing to come. That's what I feel.
Shaukato, so is it going to be a challenge both for the Reserve Bank of India and for banks, and will it be for better or for worse, Shaukato?
So, I mean, planning anything better is always a better option. So, there is no doubt about that, with the caveat that unlike other developed markets, like Mr. Gandhi is mentioned, so we are vulnerable to two uncertainties. One, of course, foreign capital flows, which banks will not be able to predict, cannot, which is very difficult, because these are basically exogenous flows that come in. And secondly, even domestically, I think the Reserve Bank needs to work with the Government of India to be able to predict government balances, which is something that the Reserve Bank has progressively put in more and more data into the system on government balances. But I think banks need to get a better handle on how to get how to be able to model existing government balances better, the balances with the state governments in terms of the 14-day T-bills, etc. So that emerging ecosystem of banks working with the Reserve Bank and the Government of India to try to model balances better will be a key factor in the success of this longer term planning with the Reserve Bank. But together with this, there are also other settlement mechanisms that need to be put in place. The current, I believe Mr. Gandhi would be able to tell you better on this. The T+2 settlement for GSECs probably need to be, T+1 settlement probably needs to be brought closer to T+0. So, almost an instantaneous settlement. So, mechanisms like this need to be put in place for this longer term planning of liquidity to be successful.
Yes, you're right on that, Shaukato, entirely, except that, you were talking about RBI having a better idea of government balances and banks having a better idea in turn, except the tragedy really is that the government itself has a very poor idea of its own cash balances, and that really is the bottom of the problem and hence the demand for government moving from cash to accrual system of accounting, etc. But I'm afraid it's time for us to slip into a very short break. Please to stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili. I'm in discussion with two stalwarts, Mr. R. Gandhi and Shaukato Bhattacharya. Mr. Gandhi, in the press conference after the statement, the governor also added that the RBI has several ways to incentivize growth, but he really failed to elaborate. So I have two questions for you. If you accept what the governor says as face value, has it done enough? Will the relaxation for computation of cash reserve ratio CRR by deducting the incremental lending to MSME, retail and auto, and that also for just 6 months, restructuring MSME loan and extension of time for commercial real estate, will all this really result in an increase in credit offtake? And what further armory does it have, given that the central bank's remit really is essentially price control? Mr. Gandhi?
Yeah, obviously when the economy is at the bottom, monetary policy effectiveness will always be less as compared to when the economy is up and it wants to control the inflation, when the monetary policy will be highly effective. That is given. But given that the rest of the tools which the Reserve Bank has, it is to create sufficient environment for confidence building and encourage the bankers to do. But beyond that, it is the bankers who have to take that ultimate call. So to that extent, when he says that there are further things which can be done or needed to be done based on the situation as it arises, the Reserve Bank has to rack up its brains and find out a method. As of now, it has chosen identified segments of the economy which needs to be encouraged, because CRR exemption have been given for the specified credit segment, retail and others. So it should create it should be possible for the banks to pass on that benefit to the customer in terms of reduced interest rate, and because of that, this particular type of credit offtake is encouraged. That will be possible. And MSME, of course, because that is a regulatory forbearance which has been given as of now, that will ease the pain of the MSME sector. But to encourage more funds flow to the MSME sector, the one a possible avenue where things will have to be worked through is the typical problem in our MSME segment relates to the cash flow on their bills which they have, the supplies that they have made to big industries, or more specifically government. There the cycle, it runs something like 9 months to 12 months before a bill is paid to an MSME. So that means that sufficiently longer period of bill discounting or bill purchase facility, if the banks would be able to offer to the MSMEs, that will increase the cash flow to the MSMEs. For that, as of now, yes, banks are free to design, because there is no Tandon-Chore committee norms so far. It has been completely left to the individual banks board's policy towards that. But banks are still implicitly following the old norms. That to encourage a different type of approach, if Reserve Bank could support or bring out some kind of policy initiative, that could be that I would see another action that is possible by the Reserve Bank of India.
Shaukat, the same question to you. Does the RBI in truth have many ways really to incentivize growth, given that monetary policy, as Mr. Gandhi also mentioned, is most effective when prices are rising, and in a situation where we might even be in a liquidity trap? What can it really do for growth directly? We have so much of surplus liquidity. Also, in hindsight, the kind of sagacity and forbearance that the Reserve Bank is now showing for commercial real estate, for MSMEs, had it shown it, say for the power sector, there maybe we might not have been in the mess that we are today. Whereas there, the Reserve Bank of India came down very sharply and said, regardless of whether it was a cancellation of coal block auctions, etc., if you are in default, you go to the through the IBC route. So in hindsight, has the Reserve Bank learned? Is it much too late? Does it have enough weapons in its armory to promote growth? Saugata.
So I think you've mentioned this so beautifully. I think so. Stepping back for one step, I think to a certain extent the inflation targeting function, to a certain extent the inflation that we are now seeing, driven mostly by not just vegetable prices, a broader food basket, might not be all that bad. I mean, the milk prices that we are hearing is actually might actually put a little bit more incomes into farmers' pockets. I mean, cereals, etc. So some inflation might actually begin to create the demand that we are so desperately looking for. Of course, there are so many caveats to saying this, that you have to be very, very mindful that this doesn't spill over into a much larger basket. But some little inflation might not be all that bad. Secondly, in terms of the key question that now, we need to worry. Forget about now rate cuts and things. So I shouldn't be saying this on a public channel. I think the government of India, probably the Reserve Bank of India, should not be acting like bond traders. So it's not as if, we need to be very, very mindful. We need to stimulate demand in some way. And the biggest problem that we know of in stimulating demand is credit. We need to increase credit flow. So given this, what are the key in the armory of rates, whatever? It's not just SLR, CRR, LCR, some of the other prudential measures, the micro prudential measures, not just the macro counter-cyclical prudential measures, the micro prudential measures. That, remember, in the last upcycle, very strong upcycle before the credit policy, we had seen Governor Reddy at that point in time tightening a whole bunch of prudential measures, so increasing risk weights in certain sectors. Now, it is obviously, there are risks, there are potential benefits. So the analytics that the Reserve Bank needs to deploy, given the data and the insights that it has on key particular sectors, what are the collaterals available, what are the values of the collaterals, etc. I think that will be the key driver for how much of each of these micro and macro prudential measures it needs to deploy to try to get credit to a certain. And remember, whatever measures we have seen yesterday are essentially in the range of facilitative measures.
Yeah, I'm strongly of the view that the RBI in fact should have resorted to more macro-prudential measures rather than try and play with interest rates. In fact, the Bank of England former Governor Mark Carney, in his last interview to Financial Times, he said monetary policy is best when it supplements interest rate policy with macro-prudential policies such as lowering the capital requirements of banks. Now, if somebody like a governor of the Bank of England was willing to countenance lowering of the capital adequacy requirements, it's very difficult to understand why RBI is not willing to look at something like that. That would have incentivized banks much more, but of course, that's a question for another day. Mr. Gandhi, at the press conference, the governor also patted the Reserve Bank of India for better transmission of interest rates, and he pointed to the fact that even for long-term government securities, interest rates have come down. Now, how much of this has really become because of Operation Twist? And is that really correct to say transmission is better? Or was it made to become better through RBI's intervention with desirable or undesirable consequences long term, maybe, Mr. Gandhi?
See, Operation Twist has been, as Governor did mention also, it is to make a subtle correction on the yield curve. So, and based on that cue, because market always follows the cues given by the central bank. So, that's why when such a correction is made, then it passes on down the line. And it has always been the case that within the whichever segment which are dependent upon market related cues, transmission has always been better. It is in the credit market the transmission has been lagging behind, and that of course by definition also it will lag behind, but in our system we have, because of other infirmities, it has taken longer time. But at the market based transmission from GSEC to corporate bonds to that CPs and CDs, that response has always been good. And this time also, the moment the Reserve Bank announced Operation Twist, it has also resulted in the correction, the needed correction that it has been aimed for.
Shaukato, is there a danger of incentivizing forex flows, as we've seen in the budget, the announcements in the budgets, and subsequently the announcements in the monetary policy also, at a time when we already have huge liquidity and we also have large inflows of forex? Forex reserves are very high. In the last 1 year, they've gone up by $58 billion, and huge further inflows, particularly of portfolio flows, always make you much more vulnerable. Should the Reserve Bank of India also take into consideration what are the implications of incentivizing forex flows at a time where there's always a danger of this liquidity feeding into inflation? Shaukato.
Well, so two things. You're absolutely right that, as of now, we probably need forex flows, as we have seen in the inflows of external commercial borrowings, FPI inflows into equities, which is probably not as bad as FPI flows into debt. We have seen a significant outflow of FPI money from debt, which is probably good, deleveraging foreign flows. But on the other hand, we have external commercial borrowings. The good thing about external commercial borrowings, etc., is that they are longer maturity. So they are more difficult to get out of. So there are holding periods, etc., with longer maturities. So that's a good thing. But that is a clear signal that we need to start working on our fiscal, our macro consolidations to make the underlying economic structures more stable. So having said this, I think one of the things one of the reasons that we need foreign flows is that bond yields have become very, very dependent on Reserve Bank of India support in one form or the other, whether it be the open market operations to try to manage liquidity, Operation Twist, etc. So I think bond yields have become very dependent. I think that's one of the reasons that we need foreign flows in the short term, but that needs to be managed very carefully. I completely agree with you on this. Second, in terms of the transmission that you talked about, I think what needs to be done is reduce. We have heard that small savings rates will be reduced. I think that's become a key factor in both transmission, in both allowing banks to reduce rates, because the higher the flows into small savings, bank deposits get affected to that account, and that keeps the cost of funds for banks high, impeding transmission. So I think these are the two things that the government, but unfortunately the budget, a lot of the borrowings, a lot of the fiscal deficit, the expenditures are now dependent on being sourced from small savings. So the government also needs to balance the needs of small savings versus the costs that are a problem for bank deposits.
But we're running out of time, Mr. Gandhi, so let me just ask you one last question. The RBI's plate in terms of supervision, they've been piling on more and more into it. You already had banks, then you have the NBFCs and the housing finance companies, now you have urban cooperative banks. At the time when the Reserve Bank, despite its relatively stellar record, has done quite poorly for itself in the matter of supervision of banks, does the Reserve Bank really have the bandwidth to do justice to this vastly increased role, Mr. Gandhi?
Actually, I may disagree with you in the sense that it has expanded its scope, whether it is banks, non-banks, and the cooperative banks. They are always been under the direct supervision and regulation supervision of the Reserve Bank of India. If at all it had acquired in recent times, only the supervision and the regulation over the housing finance companies. That's the only one. Otherwise, the Reserve Bank has already got the bandwidth across all these things. What has been proposed now is that the statutory arrangement of Reserve Bank of India over the urban cooperative banks, which was kind of a divided responsibility between the government, between the Reserve Bank of India and the respective state governments in many of the urban cooperative banks, and in the central urban cooperative bank, central cooperative banks, it is central government as well, multi-state cooperative banks. So that is the one which it is proposed to be corrected, and given the complete statutory responsibility on the Reserve Bank of India regarding supervision. That's the only change which has been proposed.
I would agree with you, Mr. Gandhi, over there, except for the fact that if that were the case, then why did we have an ILFS? Why did we have a Yes Bank, an ICICI Bank? All the cases that we've seen in the recent past does suggest that the Reserve Bank wasn't really living up to the kind of reputation it had in other areas when it came to the matter of supervision. But I'm afraid we've run out of time completely, so I'll have to end this discussion now. Thank you so much, Mr. Gandhi and Saugata, for joining us in this discussion and explaining to our viewers what is it really that is different about the Reserve Bank of India's latest monetary policy. Has it bitten off more than it can chew? Let us keep our fingers crossed and see whether the RBI has called right, because the stakes are very, very high. Thank you so much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at TT Now.